Welcome, everyone, to another edition of Ask the Expert. Today's guest is Andrea Gray. She is the Managing Director of Wealth Management at Momentum Advisors, and she brings more than 27 years of experience in the financial services industry. Andrea, welcome to Ask the Expert.
Thank you, Brittany. I'm so excited and humbled to be here.
27 years. That means you started in kindergarten as a financial advisor.
Exactly.
Andrea, listen, I know that you have extensive ties in the community. Your family is well represented in things that make life better for Black people. But what I want to know from you is what's got you started? We're going to talk about some important subjects that require your expertise, but what got you started in the financial services industry?
Absolutely. And thank you, Dr. Soares, for having me. I'm really excited to be here. What really got me motivated to pursue a career in financial services, as many things in life, sometimes our own life experiences sort of nudge us or position us for what we're called to do. And growing up with parents who were divorced, but very much co-parenting, I recognized the way in which my mother worked. And I was a good student. I took an accounting class in high school. I thought that I wanted to major in business. And my mom, who had not completed her bachelor's degree yet at that time when I was in high school, said, well, if you're going to work in business, you should study accounting because you will always have a job. So I heard stability. And so that's what I did. I went to Hampton University. I majored in accounting. I did well, but I still felt like there was a calling to go in another direction. So as a student athlete, I was a track and field athlete, even into college. I saw a trend that was happening with professional athletes who may have come into money or wealth for the first time. And unfortunately, I saw them lose it. Mm-hmm. So my heart wanted to help, to be an avenue to educate and to help that not happen. But I didn't know how to do that. I didn't have any connections that I was aware of. So I took the steady, stable route, and I started working in public accounting. And, that led to some progressive roles at some big name firms, large and small. And then later in my career, early in my career, I spent time as an auditor, compliance leader. Doesn't sound exciting, and it wasn't, but I learned a lot. I learned about every aspect of the economy, how to make money, how to preserve money, how to grow money. But mid-career, I would say, I felt compelled to I realized that I wasn't fulfilled in the work I was doing. I was learning a lot. I was helping people. I would often get tapped to be a speaker or a workshop facilitator at work in the community. And people would come to me with questions, and I'd say things like, well, I work for a company that does that, but that's not what I do. And so both of you probably know, if someone asks you a question or thinks you should be doing something and you hear that over and over, then maybe you start to think I should be doing that too. And so it was a bit of a natural progression in some ways, but in other ways, I just had to make a decision that I was going to step away from my fancy title and my steady, stable income and take a chance. And it's been all good ever since. I have been involved with community initiatives, everything from junior achievement. I was a Better Money Habits champion in my role at Merrill Lynch and Bank of America. Within the Central New Jersey chapter of Delta Sigma Theta Sorority Incorporated, I've been a proponent and a teacher and a deliverer of D-Free initiatives. So it's all been building up over the years. I just had to trust God and make the decision to kind of walk in what I felt like was a calling.
I love that.
Brittany, what's so interesting to me, and I'm sure you've seen this as you've interviewed financial professionals, every Black financial professional I've ever spoken to describes their work as a calling. It's not just about making money. It's about helping their families, their communities understand money and get the most out of money. It's really an interesting dynamic that it's not just preachers and missionaries that have this calling, but people in professions like Andrea's profession. And Andrea, what I want to know from you is, I don't think we ever asked this question before. Why should more of us think about becoming financial professionals to do what you do?
I love that question. I appreciate that question so much. There's such a need, right? We have years and years of systemic barriers to overcome, years and years of doubt to overcome, years and years of being left out of opportunities to overcome. And there is a trust factor when you can sit across the table or in a virtual setting from someone that you can trust and that you know is culturally relevant. Cultural relevance cannot be underestimated, should not be underestimated. We've lived some of the same stories, some of the same scenarios, some of the same situations. So there's a trust there. In addition, there's room for all of us. There's room for all of us. There's just so much need in the community for what we have to offer. And I'll go a step further and even talk about the influence of Black women in this industry. There is a nurturing calling, if you will, for the way even I think Black female advisors and financial professionals sort of take care of the family and take care of businesses and take care of the community. That's in our DNA. That shouldn't be overlooked as well. There is a great need and a great hunger for information. You know, I think it's fascinating that we live in the so-called information age, and there's so much information that's out there. If we were to log into, and I'm gonna date myself in saying this, Instagram or TikTok, Facebook, Twitter, there is no shortage of information that's available. And some people will take that information and take action. There's also some misinformation that's out there as well. So even though we have access to a lot of information, some of the most intimate things that we deal with is our health and our money. And sometimes you just need to talk to a human being that you feel like you can relate to, who will listen and understand what you've been through, because we've either been through it or someone in our family or someone in our community or our network has been to it. So I think it's a coming together of cultural relevance, need, overcoming historical barriers that have kept us out of opportunities to be educated about our money, to grow our money, to protect our money, and so on and so forth. So I just feel like there's room for all of us. And I love to see when we choose to be in these careers.
I love that, Andrea. Listening to you, you just sound, I can understand now why your clients work with you to figure out ways to protect and to build their wealth, because you say it in such a way that is so welcoming. So thank you for sharing that beautiful perspective. And we are so excited to have you here today, because I know so many people have been watching the headlines since March with everything from the Silicon Valley Bank and Signature Bank collapse. And people are wondering, you know, with everything going on, are banks still safe? And given your professional experience, what would you advise, say, any of your clients if they're asking you, should they still put their savings in banks?
Absolutely. So we can't ignore the headlines, right? But we can control how we respond to it. And first is just understanding how banks work, what happened in these specific scenarios. So I can also tell you, I lived through the financial crisis, not as an investment advisor or financial planner, but as someone who was still in that regulatory environment. And so when you start to hear things like banks failing and what happened with Silicon Valley Bank and some other banks that followed in the week or two after that, it's scary. So we have to acknowledge that, how we feel about what's happening. So that's kind of first. But I also evaluate banks and other companies, because the question I get a lot as a financial planner, as an investment advisor is, oh, should I buy this stock? Should I invest in this? And so, again, I started as an accountant, so I'm pretty measured and organized. And so I think about banks the same way that I think about people. So we first have to think about balance sheets, right? Does the bank own more than it owes? Is the balance sheet solid? Just like I think about individuals, do we own more than we owe? So that's step number one, just in evaluating if a bank is safe and sound. Do we not have too much debt? Can we pay our bills on time? So if you're looking at a bank's balance sheet, you can determine if it owes more than it owns, which is not a good situation to be in, but can they pay their bills on time? And further to that, can they pay their bills on time if income is disrupted or reduced for any reason? We're all dealing with inflation, higher interest rates. So how is a bank positioned to handle that? And then the third point that I think about when I evaluate banks and other companies is diversification of income streams. So banks earn their money by holding our deposits. They also earn money by charging interest on loans that they give. They might earn money from other services they provide. So if they're not earning money on deposits and they have some cash reserves on the side to still be able to pay their bills on time, they're probably pretty safe and sound, because when this income stream is not really happening for it, or for us, if we're talking about people, we've got other places we can go to make sure we can still operate, number one, but also have some income coming in to meet other obligations. So I think about those three things.
So let's pause right there, Andrea, because the average person doesn't know how to analyze a bank
Absolutely
the way you do. And folks, this is why we do this series. We want you to understand what experts know how to do, because there are times when, instead of trying to figure it out yourself, you should talk to an expert. You just heard Andrea talk about a way to assess a bank. Most of us have never looked at a bank's balance sheet. Most of us don't read the proxy statements for banks that are public institutions. Most of us don't know how much a bank owns or owes. And we don't have to, because there are people who are licensed and trained and educated, which means that before changing banks or making a banking decision, instead of talking to your barber or your beautician, you got to talk to someone like Andrea. And I just want you right now, if you're watching or if you're sharing, make sure you go to dfree.com/get-help, because sometimes the help you need is just good professional advice. Sometimes you need a second opinion. So Andrea, I appreciate all of what you said, but the average person is not going to do that. And the average person doesn't have to do that. That's why people like you exist. And I really thank you for breaking that down, because what you described is basically the D-Free formula, pay as you go, don't owe more than you own, pay your bills on time, live within your means. We want that for individuals, and we want that for institutions. And if you don't know whether or not your bank is safe, talk to Andrea, and in 3 minutes, she can go through the analysis he just described, which could take you or me 3 years. So thank you for that.
Absolutely. And thank you for driving that point home. If it's okay, I would also like to add, while that is an area of expertise for me, and I can do that quickly, there are some things that the average person can do in addition to going to the D-Free website. And it's this: understand if the bank where you hold your cash is FDIC insured. There are protections. We can have a lot of criticism about our federal government, and it's warranted, but there are protections under the Federal Deposit Insurance Corporation. And the way that you know if your bank is FDIC insured, if you want to do it virtually, if you go to your bank's website, or if you're using your bank's app, there is probably a symbol and a statement there that says that they are. If you walk into your bank branch, if you're like to touch and feel and talk to the tellers and you bank at a community bank, there should be signs posted that says they are an FDIC insured entity. Now, know that that is not the end all be all. There are, you do need to understand that those FDIC insurance protections are limited to $250,000 per depositor per account type. So you can extend or maximize your FDIC insurance protection at one bank, depending on the types of accounts you have there and how those accounts are titled. So that's going into more detail, but that is at least one thing we can all do in addition to going to the D-Free website, is understand if your bank is FDIC insured.
That's absolutely true. It's basic. And if you don't know, call the bank and just ask, are you FDIC insured? But
yep.
as Andrea said, it should be visible. It should be obvious. Banks want you to know that they are FDIC insured, because it means that if the bank goes out of business, your money is protected up to $250,000, unless you're Silicon Valley Bank or Signature Bank, in which case the government protected everybody's money because it was going to cause a systemic problem. Andrea, in terms of banking, what kind of bank accounts should people consider converting into investment accounts? At what point should people go from banking to investing?
So here is where you might need some customized advice. Sometimes the answers to some questions is it depends, and it depends on your individual financial situation. But not only that, because that's a point in time, right? Even when we talk about balance sheets, that's a point in time. That's not necessarily what always is or what will be tomorrow. So when you think about the types of accounts that you should have, or when you might want to consider moving from banking to more into the investment space, is understanding how much cash you have on hand and what the purpose of that cash on hand is intended to do, and the time frame in which you might need to do that. Mm-hmm. So if I think about an individual, I'm thinking about individuals, and I'm also going to talk about business owners because the needs might be different. So for an individual, if you have $250,000 or more than $250,000 in cash, think about your why. Like, why do you have that much cash? And whether or not the goals or the plans that you believe you have for that cash is far out into the future. That might be a time to consider having some of that cash in place to be invested so that it can grow. We're coming out of a season where interest rates have been historically low until the last 6 to 12 months. And the cash that we have in the bank hasn't been serving us because it hasn't even kept pace with inflation because interest rates are so low. We like low rates when we need to borrow money because that means the cost of borrowing is lower, but it doesn't serve us if that money isn't really growing. And you can make a case that historically, over time, your money grows at a faster rate and at an accelerated pace if that money is invested versus just sitting in cash. However, if you have plans or needs to use that cash for something very much in the near term, it may not make sense to expose that money to the risk of what could happen in the markets. So because we can't control what happens in the markets, we can use history and data as a trend to project what might happen. But as you all know, the same way that there are signs and disclosures that say, if a bank is FDIC insured, in the investments world, we say, hey, past performance doesn't guarantee future results, because they don't, but they can be an indicator. So if you have plans for that cash that are medium to long term, so I'll say 2 to 3 years out or longer, it probably makes sense to put some of that money in a position where it can grow at a faster rate than if it's just sitting there. However, if you have a goal or plans that are in the near future, 6 months, a year, 2 years, there's no guarantee that that money is going to grow in the markets. And it may today, in today's interest rate environment, be safer and grow a little bit better with less risk, because you can earn upwards of 4 or 5% interest just having in a bank or a CD or a bond that matures in a shorter time frame. But when I think about business owners, your cash flow needs may be different. Before I talk about business owners, I would also add that I'm sure as part of the, it's not I'm sure, I know, because I've taught the D-Free curriculum. I know that we also want to have emergency funds available. So if we think about our plans, we also have to prepare for the unplanned and the unexpected. So you'll want to leave some of your cash reserves as an individual in cash because it's liquid and you can do what you need to do if your income is stopped or disrupted or interrupted. But when I think about business owners, the cash flow needs might be different. But similarly, the business has to be well managed and you have to know what your obligations are or what your plans are. So if I'm a business owner and I have employees and I have payroll that I need to meet, I might need to hold on to more cash than an individual would because I need to pay my employees, or I need to pay for equipment or other business expenses that keeps the money and the revenue coming in. So business owners have to think about their cash flow needs too. So whether you're an individual, a business owner, a nonprofit, it's all about knowing what your needs and your goals and your plans are and making those decisions based on that rather than, you know, the hottest product that comes out that you hear on the investment side. Investments take time for your money to grow. So you have to be patient. So you have to assess your own level of patience and your own level of risk. There's an emotional thing that comes into play too. Some people can't take the ups and downs of the market. And so you kind of have to know yourself, or if you're working with an expert or a professional, you know, hopefully that person brings some comprehensive knowledge, not just the numbers, and helps you determine what you can live with. Because I don't want to be stressed out by you either.
You know, Brittany, the two key words that Andrea used were risk and timing. And both of those words really speak to a need for planning, that we shouldn't just spend money. We have to have financial plans. And what I understand about you, Andrea, and the whole firm, Momentum Advisors, is that you help people with planning. If we don't, you know, the old adage is if we fail to plan, then we plan to fail. And it's true with our finances as well as the rest of our lives. So Brittany, you're the professional. You can ask them some of your professional questions. You know, I asked just basic, you know, grassroots questions, but you know, Andrea, she asked the professional questions.
No, Dr. Swords is great. Andrea, honestly, it's really wonderful listening to everything that you brought. I can understand truly why your clients really enjoy working with you. You're so calming as you're talking about it, but yet bring such a wealth of information. So thank you for all of that. My question is in regards to the market. I know throughout the end of 2022, going into the beginning of 2023, everyone keeps thinking, okay, when are we going into a recession and when are we going into a recession? And so as they're looking at, you know, the rising inflation rates, as they're looking at the higher interest rates and they're worried about recession, what is something that you would recommend for people to do now with their money? Like if they come, you know, tax season, if you're coming into your tax money, what is something they should do with it? Should they hold on to it? Should they put it into a CD?
Mm-hmm. Yeah, that another excellent question, and another answer that says it depends. Mm-hmm. So it's interesting. When I look back over the past even 18 months, we've been talking about a looming recession for well over a year. And, you know, my reaction to that is there are some principles and behaviors and good actions that stand the test of time, whether we meet the formal definition of a recession or not. So these are just good things to do in all economic environments, so that whether the US economy in particular reaches the technical definition of a recession, which is 2 consecutive quarters of negative growth, we certainly feel like we've been in a recessionary environment. So it's not as important if an expert declares that there's a recession or not. It's more important to think about where you are, as Dr. Stories has said, and having a plan based on not just where you are currently, because where we are is not necessarily where we want to be, but we have to take into account where we are currently and think about the roadmap. What's the best route for us to get there? I very much think about it as a money map or a destination. Like, I remember long ago, before we had smartphones, but GPSs were a thing. And sometimes I would travel into New York City, and in my auditing days, I would have to go to different firms in the city to conduct their audits. And, sometimes when GPSs were new, but not as evolved as they are today, the voice on the GPS would say, head east. And I'm going, okay, I'm in New York City. I don't know which way is east. So I'm doing the whole thing. The sun rises in the east, sets in the west. I would love to head east, but I don't know where I am. So I would have to build extra time into my walking commute in case I walk 2 blocks in the wrong direction. And oh my gosh, it's cloudy. The sun's not even out. So I'm like, okay, well, where's the river? And, just trying to figure it out. So knowing where you are currently is pretty key. But a couple of things that we can all do: know your current financial position, be clear and intentional about your goals, because you could have 2 people who are similarly positioned and have similar goals, but they've all got something different and unique about their individual situation that's going to make one of them take one route versus someone else taking a different route. And so your destination could be the same. You could profile similarly. When we talk about the expression keeping up with the Joneses, I may live in a similar house as my neighbor, but I don't know what type of income my neighbor has. I don't know what type of assets my neighbor has. I certainly don't know what kind of expenses my neighbor has. And so our route to a similar destination, even coming from what is perceived to be a similar positioning, may be completely different for a host of different reasons: taxes, goals, expenses, feelings and emotions, health. There's so many factors that determine where to go. So knowing where you are currently, being keenly aware of your plans, knowing if you need to talk to an expert or not. Not everyone needs an expert, or not everyone is in a season where they need an expert. There, again, are so many resources that are accessible and available, but knowing where you are. If you are an investor, whether you're working with a professional or not to manage your investments, look at your allocation. How much of your money is going to risky things? How much of your money is in less risky things? How much of your money is in cash? You really need to do a check-in every now and then and see if your money is aligned, not just with your goals, but also with your risk tolerance. Because sometimes, just through natural attrition and things that happens, the slices of our pie, I'm a foodie, so I talk about things in food terms. How is your pie divided? Is all of your pie in the riskiest pie category as possible? That's not going to feel good when you have a year in the markets like 2022, which is one of the most difficult years in the market since the financial crisis. So when we had the convergence of failing banks, it felt like we might have been headed towards a financial crisis beyond a recession, which is really scary, right? We're just dealing with this once in a lifetime, hopefully, global pandemic. So there's a lot to be scared about and nervous about. But if you just take a step back, assess where you are, think about where you're trying to get to, that goes a long way, whether there's a technical definition of a recession or not.
Thank you. I know we're close to our time. I have one more question. I kind of want to go back to what we talked about in the beginning. You know, if people are worried about their banks, you said a great statement. Look at the bank's balance sheet. Dr. Sori said it's really important to talk to someone like you, Andrea, about it. So Andrea, if a client comes to you, they talk to you about it, you look at the balance sheet, and if they realize, okay, maybe this bank really isn't doing so well, if they realize at that moment that they need to move their money, whether they're an entrepreneur or whether they're a person at home, do they work with the financial professional to move their money, or is it something that they kind of like get a step-by-step process to do on their own?
Absolutely. Happy to answer that question, but I do think Dr. Sories was going to comment there, so I'll let you guys decide if you want him to make his comment or for me to answer the question first.
No, I'd like to hear the answer here, because when the Silicon Valley situation occurred and then Signature, I moved the money quickly I didn't talk to any professional. I didn't talk to my accountant. I talked to my financial director and said, move this money today. So I'd like to hear the professional's advice, because perhaps I missed something.
Absolutely. So it's your money, right? So anyone who feels compelled, whether it's emotionally or they have substantial reasons to do that, it is your money. You are always in control of your money. So you don't need to consult with anyone to do that. You can go to your bank or your financial institution. You don't even have to physically go anymore.
Right.
You can, if you're doing online banking, and studies suggest that 2/3 or more of the United States population does some form of electronic banking. It's probably even higher to that with the evolution of, cash payment apps and things like that. You can even transfer your money from one institution to another electronically. So it is absolutely something you can do yourself. If you've got a complex financial situation, you may want to pause and think about how you want to move your money and where you want to move it to if your situation is complex. But the actual action of moving it, it's all up to you, because it's your money. And if a financial professional is a fiduciary and they're honest and they have integrity, they won't have that kind of access to do it for you unless you have explicitly and in writing granted them the authority to do so. So I do have a few clients who have given me the authority to move money on their behalf. But I always let them know what I'm doing and why before I do it. I have other clients who trust me so much, and I'm like, thank you, but no thank you. They're like, hey, I struggle with this online banking stuff, so can I give you my username and password? I'm like, absolutely not. And don't you ever do that for anybody. I appreciate that you trust me blindly, but don't trust anybody blindly. You always need to be in control of your money. And if you are busy or have a complex situation and you have an expert that you trust who can do it for you, know that that needs to be in writing. And just the person that I am, you just obviously want to make sure you trust that person to do that.
Well said. Thank you so much.
I have a full-time finance director for my businesses, but I get a financial report every Friday, and I look at my accounts every day. So to your point, I learned that really from Oprah Winfrey, who learned it from Bill Cosby. Bill Cosby advised Oprah Winfrey, no matter how big she gets, you sign your own checks and make sure you're controlling your money. I have two questions, one of which probably can be kind of offline, Brittany, but the first question is, a lot of people have 401ks and 403bs. They have retirement investments through their jobs. And I have found that the majority of the people that we've talked to have no idea where the money is, have no idea how it's invested, have no idea what the balances are, have no idea what the restrictions or opportunities are. Could you help us advise people, if they have 401ks or 403bs or retirement plans through their employers, how they should be doing, what it is they should be doing related to those funds?
So I am so excited about this question, because while I have some experience in the early part of my career in the banking and regulatory banking environment, retirement planning is my jam, as I like to say. I do have a retirement planning designation. And the reason I'm so passionate about the subject of retirement planning and why I'm so excited about responding to this question is because that was my foray into the investments world. And I had a role earlier in my career where I did the tax reporting for retirement plans. Also sounds boring, and you could argue that it is, but I learned the ins and outs and how they work. But the real reason I get excited about retirement planning is because retirement plans are accessible to everyone. Not everyone has access to the same type of retirement plans, but retirement planning is something that is important for everyone to consider. I don't care your age. I don't care if you work for an employer, you have a corporate job, you work for the government. If you're self-employed, retirement plan is important for everyone. From if you get a paycheck, if you get income from doing work, you need to be thinking about retirement planning. And I had the awesome opportunity to be exposed to that at a very young age. So I get really excited about it because there are so many ways to tap into those assets for reasons other than retirement. We are not going to talk about that today because that's very unique, specific situations. But here's what you should do. Because I have found what you have found, Dr. Stories, is, I'll sit down and have a consultation, a complimentary consultation with someone just to see if it makes sense for us to work together. And I'll tell them, you don't need me right now, or you don't need anyone right now. But here's what everyone should be doing. You have to take an accounting of what you have. Think about all the places you have ever worked. And there is a possibility that there is some type of retirement assets connected to that employer. Whether it's in the form of a pension, that's something that you can potentially receive later in life when you reached a certain age or a certain years of service. It may not be accessible now, but you want to know what you have and what's available to you. And so the accountant in me can talk about this very easily, but it can be pen and paper. It can be, a Google sheet, or it can be an Excel file. You just need to list out what you have out there, but you also need to access it. And so in today's environment, when so much is available electronically, some people may not be comfortable with that. There should be a statement somewhere that you have that says at a certain point in time, this is what you owned, this is how it's invested. Even if you don't remember, if you check with the big 401k, 403b managers, your Fidelities, your Vanguards, your maybe Charles Schwab's of the world, Merrill Lynch's, you will find that you can easily get information. You may have to wait on hold a while to get to a representative, but if they cannot authenticate your identity and they can verify your terms of employment, the years you were employed there, they can usually tell you if you have some assets in a plan. But what you want to do is not only know what you have, but what types of retirement assets you have, because some of them have very similar features and rules, but there are some differences. So you want to know what you have and what types you have. Once you kind of have your arms around that, then it gets into well, what should I do with it? How far away am I from retirement? I will also tell you that when it comes to assets in a former employer's plan, so you don't work there anymore, if you've moved on, you usually have 4 or 5 choices with what you can do with that money. You can take a distribution, meaning you can just take the money out and receive it as cash to yourself. So they will sell whatever it's invested in, and they will cut you a check, and it's money to you. But that money, typically, unless it's been provided on an after-tax basis, most of the time that money is going to be considered income to you that year. So you kind of need to think about, am I earning income right now? How much? Because if I take this money now, I could end up losing some of it to taxes because it's intended to serve you in retirement when you reach retirement age. For some plans, it's 55. For most plans, it's 59.5. Some plans will force you to take distributions if you're at age 72, but you need to understand what you have and the rules around it. But those are one of the choices, is take a distribution. Another choice could be to roll it over into another employer's plan. So if you've had former employers, but you're with an employer now that has a plan, if that plan can receive assets from another plan, you can roll it over, a tax-free distribution, because it's not coming to you in the form of cash. It's just going from one type of plan into another. So if you have former employer assets and you have an employer that has a plan now, seek out your summary plan description, or your SPD, that of your current employer, and that will inform you as to whether or not that plan can receive money from another plan. Another option would be to roll it over into an IRA. So an IRA is also a retirement account, but it's owned individually. When you have these other plans that have for anything, that just refers to a section of the Internal Revenue Code. You're participating in that plan with other groups of people. So the cost of managing those assets is much less expensive compared to if you roll it over into an individual retirement account that only belongs to you. The beauty of IRAs, though, are just several things. One, the rollover from the former employer plan, let's take a 401k as an example, into the IRA is also a tax-free distribution. However, you can invest in things beyond what you have to choose from when it's in those plans. When it's in those plans, you can only choose from the mutual funds that they offer in the plan. When it's in an individual retirement account, you have a lot more control over what it's invested in, but with that control comes higher costs. So a lot of people don't realize that. There are some advisors like me who will always tell you to do the rollover because that benefits us. But an advisor who truly has your best interest in mind will tell you what all of your options are and advise you to make an informed decision. I turn people away sometimes because I'll say, you know what? You're not in a place right now where you should pay for my expertise. I really think you should roll this money into your current employer's plan because this is all you have. So I've talked about rollovers, IRAs I feel like there's another option that I can't think of, but just know that you have choices. Oh, sometimes your option is to leave it there. And it may make sense to do that in some cases. Again, when it comes to goals and plans, some people have a goal. They say, yes, I worked for these 3 different companies and I have a 401k here and a 403b there and a pension there, but I want to start a business now. It might make sense for you to start your business, start an individual retirement account for that business, whether it's a SEP IRA or a single participant, you, the business owner, 401k, we call them solo Ks. It might make sense to start your business, set up the solo 401k, and roll the money over from that plan into your new business's solo 401k plan, because guess what? Sometimes, and this is not a recommendation, you can borrow money from a plan, but you can't borrow money from an IRA. And in a way, you're borrowing for yourself. So it's another little untapped potential place of capital that if you ever got into a cash crunch, as we sometimes do when we start businesses, right? It might take some years for that business to be profitable and you might need to bridge, but at least you're borrowing from yourself. So while we hope that you don't need to borrow from your retirement assets to fund another goal, it can be a place to tap into if you needed to bridge, but at least you're borrowing from yourself. It doesn't affect your credit. That in those situations, I would work with a professional to help determine what the best option is for you. So I told you I was going to get excited and I may have spoken too long about it, but this is an area that is really near and dear to my heart because this is where I started in the area of advising people.
Well, it's so big, Brittany, in the activist world, we have a tendency to talk about Wall Street as if Wall Street is them, when the truth of the matter is, through our 401ks and through our IRAs, there are many, many more people who are invested in Wall Street than realize. And I do think we should have a social critique of the excesses that sometimes accompany Wall Street and investing. But I also think we need to have an honest understanding of how invested many of us are through our union dues, through our retirement plans in Wall Street. So Wall Street is not as much them as sometimes we think it's also us. I wanted to ask one more question, Brittany. I know we're out of time, but I want to ask it anyway.
Fine, take your time. Andrea's doing great.
Andrea, you are an accountant. You are a financial advisor. You are also, through the Delta Sigma Theta sorority, a D-free instructor. I'd like to hear from you, your perspective on how the D-free process compares to other financial programs, other financial courses, financial literacy initiatives, and just, having all of that background. I'd like to hear from you how you would describe D-free.
I would describe D-free as a gift and a gift that keeps on giving. There are a number of initiatives, organizations that aim to accomplish what D-free is accomplishing. And I see there's two things that stand out to me. There's a lot of initiatives, organizations that talk about the what, and that's really important. Education is really, really important, and it's sort of the first step, really, is educating people about what is and what could be. But what I think distinguishes D-free from other initiatives is that you provide the how, the roadmap. You can only retain so much information, but if it's organized in a way that it's actionable and there's a guide and there's a roadmap, I believe there's a higher probability of success because you're providing the tools and the how to do it. So it's the what is important. That's the literacy part, is understanding what things are and how they work. But the how is really how you move, how you navigate. What do you do? Thank you for telling me what to do. And thank you for telling me where to go find more information about what to do. But D-free tells you how. It's a process. It's a journey. It's a roadmap. And I think that distinguishes it from some of the other initiatives and missions that are out there. The other distinguishing factor, which I think is interconnected, is that I like to say being literate in something is a baseline goal. If I'm learning a new language, I want to be fluent in it. So I like to believe that my goal as a professional and as a member of the community is to take an opportunity and move from financial literacy to financial fluency so that you grow. And there's evidence of your growth where you can speak the language. You don't have to be an expert to be able to speak the language or know what's happening, but being literate is just a baseline goal. You want to move from literacy to fluency. And I think the fact that there's a roadmap, a process, there's guidance around the how is what distinguishes D-free. So it puts you in a position to move from literacy to fluency. And I think those are the distinguishing efforts. I will tell you, it was not my goal, but I have had D-free students that I taught through the curriculum who have become clients. And that was not my goal, right? I'm doing a community service effort through the sorority and through the partnership that we have with D-free, but it just happened because I helped somebody see what they had. This individual did not know that they had wealth and did not consider themselves wealthy. But when we sat down together and we talked about a family situation, and we talked about the emotions that were tied behind that, we uncovered some wealth that they didn't know they had. And so, again, that was not my goal. That was just a bonus. But I just think there's just so much impact because you're providing the how.
That that description is priceless. And I just thank you for your involvement, and I thank you for your answer. That answer can be very helpful to us because someone like you can probably explain D-Free better than we can. And I just that is, Brittany, we can use that answer separate from the webinar series for all kinds of purposes. Thank you so much, Andrea.
Absolutely, absolutely. And I meant to say it earlier, D-Free really was a contributing factor to me pivoting my financial services career from an accountant, an auditor, a regulatory liaison to one where I'm in a role. I'm now in the business of helping people, but I didn't know if I could do that, right? I'm an accountant, right? First, so I'm still steady, stable. All the numbers have to add up and line up. But moving into the business of giving advice was a real leap for me. So I became my own first client. So I had to go to my husband and say, hey, I know I've got this great steady job and I have a vice president title, but I'm unfulfilled. I want to do something else. I want to have an impact. So I might not make any money for a couple of years. Are we going to be okay? Oh, no, I'm going to show you we're going to be okay. And if I fail at this, I'll go back to doing what I was doing before for the good of the family, but I believe in what I'm doing. And so when I saw initiatives like D-Free and I just connected to it, I'm just talking now. I'm telling you all both as believers, I saw it. It was divine for me, pivoting to this career. And I tell the story often that I had a vision. I saw it was a PowerPoint slide, a Black background with white Arial font in bold. Because I was like, what am I doing? And I felt like that was a sign from God saying, and these were the words, keep doing what you're doing, the business will come. Because I didn't know if I could do it. It's a sales business. And that didn't sit well with me because I felt like, you know, sometimes you associate sales with taking advantage of people, but I'm like, but that's not who I am. So I had to figure out a way to marry what I knew was good business decisions with what my heart and my calling was telling me to do. And I didn't know if I could do it. And I didn't know if I would be successful at it, but I felt such a connection to D-Free. And there's some other initiatives that I felt connected with and that I'm partnered with today that I didn't pursue, but it just happened. And I haven't looked back. So
wow. Amazing. Well, Brittany, you hit a home run by having Miss Andrea Gray come and be a part of this experience. I can't tell you how much I appreciate it. Andrea, I don't make all of these. Brittany kind of carries this on her own, but I'm happy to be here today.
Andrea, you've been outstanding. Thank you so much.
Thank you.
Seriously.
Thank you. I really appreciate it.
Oh, I love it. Well, to everyone watching, thank you for joining us for another episode of Ask the Expert. Have a great day, everyone.